Hi everyone, welcome to part 2 of Option Trading for Beginners lesson. Today we're going to continue with part 2, so let's get started. Now, how does an option move? Well, an option has two different elements to get its valuation. One is the extrinsic value, which is filled with time and volatility, and the second is intrinsic value, which is occupied by the stock price itself. You might look at this and probably be scratching your head like, what does this exactly mean? What is time and volatility? What's the extrinsic part? Well, let's talk about that. One of the first that make up the extrinsic value is the time value. It will be the theta, which is a sort of element in options, or time decay, both of those. Time value makes an option increase its own value by a rate depending how far in time it's been. The time precisely is manipulated by its own expiration date. Now, I'm not saying this metaphorically. Like, I'm saying this quite precisely that an option actually has an expiration date, just as a food item has. It's actually not usable when it's past the expiration date. It's actually useless. So it's actually not. This isn't metaphorically. The options work the same way as food. Now, I know that sounds, just crazy. Like, what is this supposed to mean out of an expiration date? Explain yourself. Sorry for the abomination photo I just showed you. Okay, so looking at the option chain, as you guys remember in the first lesson, in this option chain, the expiration dates are precisely these dates. You can see here that it says March 8th, then March 15, March 22nd. But the thing is that this option chain that's open right now is this date. It's March 1st. March 1st indicates the expiration date of the options inside this chain. So by each date that you see, they're independent chains by itself. And these options, that's why it says March 1st, all these options in this chain will expire on March 1st. Now, expiration dates actually work very similarly like humans, which I know that sounds just very bizarre to say, like Terminator or something like that, but it kind of is. When an option is created, it's similar to like a baby, right? An infant that just came into the world. Let's say that today it's February and the date that it was created was on February. However, this expiration date, which it says EXPSEP, this stands for expiration date on September. Okay, so there's quite a bit of months until September. However, as time passes, right, as humans grow older and this baby turns into a child and it's still the same expiration date, but now it's March. And you can see as time passes on, it's now April, it starts to get older. It's now May, it's now June, it's now July. It's the same expiration. The only thing is that these are the current months right now. So it's not February anymore. It's now August. And then we just have 1 month until the next expiration, which is the last, moment of a human's life when they're elderly, is on September. That's the date that it was expired on. This may sound a bit morbid, but what does this actually mean? Well, options behave very similar in this nature because the way how options will value itself will be very affected depending how old that option is. So if it's very new, it's going to hold a lot of extrinsic value because there's a lot of time left until this expiration becomes expired. And then if it's March and April, these months are relatively early because they're not so close compared to these months. So these sort of months have more value in their options compared to this one. Now let's talk about that more. How do options hold its value as time goes on? Well, it's very similar. I don't know what these are called, but they're a time that's calculated by sand, right? This is a perfect example of how an options maintains its value. So let's say that this was the option created, so it's similar to this infant, right? And this option has the most time value. It has the most money with time. But as time passes on, right, it starts to reduce in the value of time. It starts to reduce its option value because the option value is comprised with time value. So this money will start to reduce as time passes on. You start to get less money on the option, less money and less money until you don't really kind of don't have anything by this point. That's how options work with time. As time passes on, and most importantly, that you get closer to the expiration date, because obviously, if I know that tomorrow, and right now the current month is February, tomorrow will be closer to the expiration date of September than it is today because we just reduced the day. So it doesn't matter how far you are. If you're closer than what you were yesterday, this time value will always decrease. Okay, that's super important to understand in options. This is what makes up a portion of the extrinsic value. Now, the other valuation on the extrinsic is the volatility. This is also known as Vega or IV. This is determined by an option's volume and the activity of that option that affects the valuation of the option itself. So as volatility increases, the option's value does so as well. But when the volatility decreases, the valuation decreases too. Let's talk about more volatility, especially implied volatility, which looks somewhat like this. So implied volatility is really supply and demand. But what's supply and demand? Well, the supply and demand of the option actually. So this is the amount of activity surrounding sellers and buyers transacting with each other with options under the stock. As the activity rises, so does the price demands increases and limits much of the spread. So you don't have to worry about what spread means until now. We'll discuss those in other lessons because it's a bit more advanced topic. But as of right now, I just want you to understand that the volatility determines based upon the supply and demand of the option of the stock. So if there's more demand than what there is in supply, people are offering a higher price than what it should be. And if there's more supply than what there is in demand, people are, well, really it's in terms of sellers. But oftenly than not, you will see that volatility is usually revolved around most of all activity. It's mostly revolved around how often are buyers or sellers wanting to transact with each other. And that determines the implied volatility. Now, when you add up that time value with the volatility value, you get the extrinsic value. But what you should know is that this determines the valuation of the option before its expiration date and when it's not fully beyond the strike. Now, you might be thinking like, what do you mean by beyond the strike? Well, this will give a bit more clarity when we talk about the intrinsic value now. So intrinsic value is how much the share price can move that can affect the option's value. If you bought a call, then as the share price moves up, your call option will increase intrinsically by the intrinsic value. But if the share price goes down, if you still have that call, that call's option will have a lower intrinsic value because it doesn't benefit on that intrinsic move. However, for puts, if the share price comes down, then you have the opposite effect where that's benefiting on the intrinsic move by the share price moving, but if it moves upward, then you have the same scenario where the put option doesn't gain. It doesn't have positive intrinsic value. So it's something simple. You can see that it's solely affected by just the share price. Now, talking about that part with the strike, that the extrinsic value is determined on the option's value whenever it's not at the expiration date or not past the expiration date and not beyond the strike. Let me show you what I mean by that. So right now, the current share price on that red circle is $111.36. If we look at the call section, let's say that we saw this strike 112. When you look at 112, which is this area, this 112 has not been passed because the share price is at $111. So it hasn't been at 112 and it hasn't gone past it. What this means is that this option does not have intrinsic value because remember what I said in lesson 1 that the option increases in value intrinsically when it goes past the strike price. It starts to behave similarly as if you had 100 shares of stock per contract. But that happens when you're beyond the strike. However, we're not beyond the strike here. So what's maintaining the valuation of this option precisely, this call option? It's the extrinsic value. It's the amount of time that there's left in this option, which is, remember, it's March 1st, so that we still have about 5 days here. And on top of that, there's still volatility. There's still people transacting in this option, which is what's maintaining this valuation. However, something that you should understand with extrinsic value, besides time value and volatility, is that extrinsic value is also valued based upon the probabilities that the price can go in the money before the expiration date. The benefits of using options is that if you have them in the money and these options expire in the money, you'll be assigned shares. Now, what is an assignment? Assignment happens whenever your options expire beyond the strike, and the broker would think that you want to convert them into shares. In this case, if you remember in lesson 1 that if you're buying shares, you have the option to exercise your options. So you don't have the obligation, but you have the option. And if they expire in the money, you have an option to sell 100 shares. Now, if you don't worry. Even if they expire in the money, they won't you won't get claimed the shares unless if you want to, which you have to contact the broker. But the reason why I'm explaining this is because that's the reason why options move by 100 shares, because it's meant that, at least traditionally, how options were made was so that you can benefit on a short-term movement in the stock as a trade, but at the same time you can also hedge an investment. That way, if the stock moved a bit up, you could benefit on the upward movement and sell your shares. It's like a hedging sort of tactic. That's how options were made, so that's why they behave like 100 shares. But it's important that you should know that these other options right here, these other options are called out of the money options because they're not in the money. They're now called out of the money. Okay. And whenever an option is right next to in the money, like in this one or in this one, they're right next to this yellow labels, which is in the money options. Those are called at the money options because they're basically at the share price. However, for at the money and out of the money options, these options are also valued based on their probabilities that they can expire or be in the money before expiration. Obviously, this at the money option is going to have more value because it's right next to in the money. So it's easier for the share price to move this option into the money. That's why these other options on top of don't cost as much, because they have a lower probability to expire in the money. So you see what I mean? Now, this could be beneficial or not, which we'll discuss later, but that's something that you should understand. When this option moves in the money, if the share price moves beyond $112, this will now be in the money, which now has intrinsic value. Okay? So if you decided to look at a stock, and let's say that you bought a call right at $112, then if the price decides to pass that $112, and if you look at the option chain at your current strike price, that option would be in the money. And it would actually cost $5.15. Because remember, as you gain intrinsic value, as the share price moves beyond your strike, for every each $1 move is $100 because of 100 shares. So if the strike is passed by $1, your option will increase by $1. Okay? However, remember that an option has 100 shares. So this says $5.15, but this will actually cost, and this would actually be valued at $515 because it's 100 shares. All right. The great thing about this is that if the share price moves up by $4, right at $116, this option would now be in the money by $4. Why? Because the share price has passed the strike price, this $112, by $4. You see, like 100, what's 116, which is the current share price, minus by 112 of your strike. That's a $4 difference. So that means that your option is $4 in the money, which you've made $4 per exactly intrinsically. Intrinsically. All right. What this means now is that your option now is valued at $915. This is the power of using options. Because look, the difference with this is that the stock went up by $4. But the problem with this is that this stock would have costed you about $11,000 just to do this trade. But when you use options, you only had to pay $400. That's a significant difference. Why? Because options are derivatives of stock. They allow you to trade based on the movement of a stock at a cheaper price because the brokers think that you're trading in the short term to accumulate shares. Now, don't worry. It's not like a bad thing, like an unconventional thing. A lot of people use options this way. They don't let their options expire, which brokers know, but that's just like the tradition of how options were supposed to be made. But this is the advantage. That's why I said that that options are cheap, because you're able to benefit on a price move. Like if you had the buying power of 100 shares, whatever stock you're using at, but you only have to pay like 10% of that value. So it's this has a lot of advantages. Now again, if the share price does not move past the strike price, then remember that you don't have intrinsic value. You have extrinsic value. And the extrinsic value are precisely these areas. They're the areas that the share price hasn't been passed on. So for the call section, because you're betting on the upside, the price has not been above 175. You see, that's why it's at the money, or at least not in the money. And for put section, the in the money option 175 is in the money because this share price is below 175 by 1 cent. So that sounds like pretty funny, but it's actually how it works. Like this is the way how puts work, and this is the way how calls work for at least out of the money options. Okay, so if those options move in the money, they have to do so before the expiration date, which determines their value on the extrinsic value part. Okay, now you might be thinking, like, why does the option have to move beyond the strike price before the expiration date? Well, it's pretty simple. The thing is, remember that when an option is not in the money, what does it have? It has extrinsic value, and that's made upon time value, and it's made upon volatility. Now, the thing is that when an option has a lot of time value and that time value starts to reduce, so does the valuation on those out of the money options. But the thing is that when an option has too much extrinsic value, so you guys should know, when any option has too much extrinsic value, especially on time value or volatility, but 99% of the time it's going to be by time. When an option has too much time, it offsets a lot of the intrinsic moves that the stock can do. What do I mean by that? If an option that has a lot of time, which means that it has a longer expiration date until today, any sort of movement that the stock would do would not significantly impact the option price. Why? Because the option price is valued upon majorly from its time. That's why people are buying it, because it's a secure optionability that you can be able to stay with the trend over a long period of time. But in order to do that, you need to pay a heavy price. You need to pay a heavy cost in order to benefit from those swings in the long term. However, because it's in the long term, we all know that a stock can move a lot more in the long term by percentages compared to the short term, right? I mean, that's pretty obvious. Like you know that a stock like Apple or Google will make, let's say, a 40% return in a year, much more likely than to make a 40% return in a month, right? Like that makes sense. So that's why in longer term expiration dates, there's time value in order to kind of regulate that sort of disorder. That way, if the price goes up not a lot, the option can maintain its value, and I'm saying maintain, not grow a lot. And that's kind of there's pros and cons, but that's something that you should understand, okay? That's why when you have the price and it's further away from the strike price, your option would actually now decrease in value because the price hasn't gone beyond the strike. The price is far from the strike, and that makes it likely now for the option to decrease in value as it decreases in also time value, okay? So if you look at the option chain, this is Amazon's option chain. These out of the money options, as they move in the money, they now have intrinsic value. And these expiration dates that are 5 days are shorter compared to these sort of expiration dates. What this means is that these options have less extrinsic value, right? There's less extrinsic value, which is the reason why these options and any options that you will see is always going to cost less compared to longer term expiration dates. They don't have as much time. And remember the fundamental relationship between a time period and the way how stocks move. Stocks don't move a huge amount in a short amount of time. So it makes sense that in a shorter expiration, they make it sort of fast or at least normal in that time frame. Even though that these options don't have a lot of time value, however, they can securely be changed by a rate based upon the intrinsic value. That's the advantages of shorter term expiration dates, that because they don't have a lot of time value and they don't maintain themselves, which could, there's pros and cons to that, but you can capture not such a very expensive option, and that option can gain a lot because there's not a lot of time value that's holding back that option. So you can see that it's like when you trade options, there's many tactics, right? It's like you go into the marketplace, it's very crowded, but you see many people who have different tactics of what they're selling. And in options, it's the same way. You start to see opportunities by what you see around the market, what sort of products or services that you see are in demand, but there's not much supply. And so you make a product, that sort of thing. Or you try some sort of sales method and provide that to another group of people. There's just an abundant source of ways to kind of make money in options because of how really lucrative it is. There's many tactics to do it. Whether you're day trading, whether you're swing trading, it works. But it really is important to understand that the exact system that you're using has to be compatible with the sort of expectation and the layout you give to that system. Now, that may sound a bit like abstract, but it's going to make sense later in the future. Okay? I just want to tell you that because these are important lessons that you should know. Okay, so now let's talk about precisely trading these sort of options. Now that you understand a call, a put, how option chains work, you kind of pretty much got the fundamentals written down. In order to trade options, the only way how you're going to make a gain in options is to be right on the stock price. So it's no different kind of when you stock trade. If you've been already stock trading, this isn't going to be that difficult because you've already got the technical analysis part. If you've never traded before, then that's fine because this is why I'm showing this. So one of the methods that I like to use is something called a hard rebound. A hard rebound occurs in a moving average. If you don't know what a moving average is, you can click on the link I'm going to have on top, and that's just a live class that I did explaining how moving averages work, okay? But for right now, I'm going to explain clearly how to use this sort of trading. Hard rebound, what you want to see is that the hard rebound occurs whenever the price is hitting not the short-term moving averages. It's either that they're hitting the 50 moving average, the 100 moving average, or the 150 or the 200. In this case, it's hitting the 50 and 40. So because it's hitting the 50, that counts as a hard rebound. And on top of that, you can see that what's important, of course, is that the price is going down. The price is rebounding. and it's also hitting a horizontal line support, right? Price is resisted, price is supported. Now it's likely to support. And if you look at this candle, this is a bullish reversal candle. So there's a lot of signs showing that the price can go up. But additionally, to look at oscillators too is important, because we can see what's another sentiment of oscillation that we see in the market. How much are people selling? How much are people buying? Well, right now, a lot of people sold recently. They were actually oversold. Whenever something is oversold, it's likely to come back to the average, which makes the prices to go up. In this case, it was oversold right over here and right over here. Okay. So there's a lot of indications that the price can go up from here. But what's important, and I like to use this, is something called an ATR, which stands for average true range. This indicator just basically tells me how much has the stock moved by average every day from the past 6 months. And the way how I get the average is by getting the lowest point of the ATR from the past 6 months ago on daily candle frames and the highest point. That way I can get the distance between these two, and whatever the middle point, whatever the middle section of these two are, that's 6.54 on that red line. What we'll do is we'll grab that 6.54 and we're going to, in this case, because we're betting on the upside, because remember that this is the average movement. This is like sort of volatility by average, how much the prices move. So $6.54 just tells us how much the price moves, whether, that's how much it's moved upward or downward. But in this case, because the price is likely to move upward from the indications in this stock, then we'll say that Microsoft will likely move in the next few days for certain by $6.54, because that's really by average how much it moves per day. So I know that in a few days, that's going to move by that quite certainly. Now, if we trace a line at that level, that would actually be at $380.87. Now, the great thing about this level is that it's right next to a resistance. It's not on top of it, but it's actually right next to it. It can be on it, but the great thing about it is that it's not a hard thing for the price to reach that average move, because that price distance of 380 is actually below the resistance. So it's not going to be a challenge for the price to move there, because it's not being challenged by resistance yet. That's the thing about trading, that when you want to trade, you want to make sure that there's least amount of resistance. That what I mean is that there's least amount of challenges, whether it's resistant lines, whether it's any sort of resistance patterns, that there's least amount of any sort of challenge for the price to move to your direction. And that can make your probabilities to get profit much more easier, which makes it a better trade. Now, because we've confirmed it, then the only thing left to do now is to go to the option chain. Viewing the option chain, we're going to execute calls because we're betting on the upside, and we're going to buy calls. In this case, if you look at the strike 380, 380 is actually right at the average distance that we'll wait, and that's actually below the resistance, so that's good. Because what's important is what strike should you choose, because there's 380, but we can also choose 375 or 377, because you would think like, well, if the price can easily go to 380, wouldn't it be better that we chose a strike to 377.5? Because we know that if the share price moves beyond the strike, it behaves like 100 shares. Yes, but it's not that simple. It's not that easy, and I'll explain why. Now, maybe some of you might think like, well, why don't we also use 382.5s, because those look cheaper. We can actually make quite a bit of money from the option not being at such a long expiration date. That way, if the price moves up a bit intrinsically, these little option valuations would go up a lot compared to what they're worth. Both cases are true, but I'm going to explain to you why I'm going to choose 380. The thing is that if we choose a strike price that's a bit, I'm not saying that 377.5 is bad, but I'm just saying that in comparison, if you choose 377.5 or at the money, the problem with those options is that they could be highly changed quickly. What I mean is that if the share price moves up, because remember, just because my technical analysis looks very promising, that the price can go up does not mean that the price will go up indefinitely. There's no indefinite situation in the markets. So I have to take this responsibly. I know that I can lose in this trade. So it's a matter of risk. That's why I said that in options, what's important is to have a risk system. That trade at the money will cost $278. Now, it's not because it costs $278 because it depends how big my account is. But the thing is that this option sort of has not such an attractive rate of return compared to this sort of option because of the way how this option can move. In culmination, if this share price moves beyond this strike, it will gain intrinsic, but it's not going to gain as much extrinsic part. So it's rather of a matter of like kind of an exchange. What would I rather have? What's like the least bad option? And I would say the least bad option is this one because at least I know that the price can go to 380, so it's not that far. And at the same time, the price that I'm paying for is good. That way that if the price goes up, this contract would easily get to my profit target, more likely easier than these. And it's because I aim to get 100% of what I'm buying. I try to minimize my risk to 50% loss. But again, there is no right answer. I'm just telling you based on my analysis. But I do want to tell you that there's not a right answer. You could choose this option. You could choose this one. Any of them work. Or 382. At least that you don't choose, something super close or something super far. What's most important is that the strike price that you're choosing shouldn't be farther than what the average movement is. It can be at least next to it. And what's best is that strike price is not beyond that resistance level. Okay. The way how we get the call, because we know what strike to choose, but how do we buy this call? We actually have to go to the ask column. So there's a bid column and there's the ask column. Every time that you're going to buy an option, whether it's a call, whether it's a put, you're always going to click on the ask. In this situation, we're going to click on the 380 strike row, which will cost about 99 cents. Now, once you click this, it should open something like this. So you can see that in clicking the ask, we now get this section below. This particular area, right where I'm showing the arrow, is actually the quantity of contracts that you can buy. So remember, each contract costs 100 shares. So if you buy 2 contracts, you're going to have something of an equivalent worth of 200 shares, or 3 shares is 300. You can just do the simple math. In this case, I decided to buy 4 contracts, and you can change this quantity by the plus and minus. The other important thing is to see this other box, which I labeled, and to see that you're choosing the right call option. So the way how I know that is that, first of all, I know I'm choosing the right expiration date because the option chain that I clicked on was January 12th, and that the strike price is correct because I know from looking at above that it's 380 and that it's a call. So everything is good there. Looking at this other area, you can see that it says price. This price indicates the price I'm paying on the ask column, and it's currently 99 cents. Then on this order section, this order, you don't have to worry much about this because we'll discuss this in another lesson, but I'm just choosing a limit order. And it's just basically a type of order where the price will be executed if it goes to that ask price. But again, don't worry about the details. I'll explain that later. I just had a limit order there. And this other section explains the type of order that I want to execute. So in my case, I just left it until day. What that means is that this option will only be executed today. It won't be executed tomorrow. In this case, the reason why I chose day is because there was quite a bit of hours until the market closed. So I was right leaving it until day. After you checked everything is up to schedule to what you wanted it to be, then you can click on confirm and send, and it should send out your order. Okay, now looking fast forward, it's been 2 days since I bought that call, and the current share price is at $378.81. The price has gone up, and looking at the option right now, the option is actually right here, 380, In the ask price is actually at $203 if you multiply that by 100 shares. This is great because now you might be thinking that how did you gain so much? You made about pretty much 100% without the share price going above the strike price. How did you do that? You didn't get any intrinsic value. Well, it's because remember what I just said earlier. I don't need the option, even though it would be great, but I don't need the option to exactly get in the option, like at least beyond the strike price, because I know that the type of option strike price that I chose had enough extrinsic part that it wasn't, it had enough, not too much, because the at the money had too much where it would be too fluctuating. In this case, I was able to get it outside of the money enough that I bought it at a cheaper price, but the intrinsic value moved up a bit that extrinsic option was able to double in worth, even though the share price hasn't gone past the option. And the reason why I'm gaining this much is because there's still time left. This would be different if there was only 0 days until expiration. This option would probably be at $103. So I'd only be profiting $4. That's the thing about options, that you have to be sure in what you're doing. Okay. Now, in percentages, as I said before, it's the probability of that option moving up. So now the option that I currently have, if you remember before, this option now costs this much because it now increased its chances of that option expiring in the money, which made it worth more. So you can see that there's like a lot of relationships here. As the option gets closer to the end of the money, it becomes worth more because it now has a higher chance to expire in the money, which makes it more valuable, hence your investment going up. Okay. Now, I forgot to erase that label, but if you look at this trade price, you can see that the price that I paid for was $99. I basically made double the price that I bought. I usually aim to make double of what I purchase, and I cut my losses when I lose 0.5. So in other words, I aim to make 100% of my trade, and I cut my losses when the trade is losing 50%. Okay, that's very important, and we'll discuss more about risk management later. But that's just an important sort of method, the way how I trade. Now, talking about puts, because that was calls. Talking about puts this time, this is now a soft rebound. You looked before at a hard rebound, and a hard rebound is the same in downtrends, because this is a downtrend, because the 100 is below the 200 moving average, and so is the 50 below the 100. But in this case, the soft rebound occurs whenever the price is hitting the shorter term the shorter term moving averages. So it'd be the 20 or the 40, and the short term trend is downward. So that benefits it, that those averages become resistant levels. But looking at the price right now, you can see that it's showing an inverted hammer, which is a bearish candle pattern. On top of that, there's a resistance level at a horizontal line. So that's also making the price likely to come down even more. And if you look at it closely as well, which I just realized, this price is actually respecting the 20 and it's respecting the 40. So that's even double the signal. This makes it likely to come down in the short term trend. Looking at the ATR this time, because that hard rebounds, you have to look more at oscillators. In this case, you kind of can just go by it as long as you have horizontal lines with a solid candle and a rebound with the shorter term moving averages, you're pretty good. And of course, the price has been going up in the case for a downtrend. In this case, it's rallying. Looking at the ATR, as you know, we just get the middle price between the high and the low, and that would be $3.7. Then, as we confirmed in the movement, then we can look at the option. So $3.7 will actually be right about here, because this is 102.5. It would be right around here. So this isn't a hard thing for it to reach, because the price, this is actually where the support is. The price is supported, the price supported here. This is a support level, and that support level is right around $103. And it's likely, the average movement is 3.7. So if you do the math, $106.56. So we can do the math. Let's get the calculator. $106.56 minus 3.7 This is the case for put option. This is where I get the average price movement of the distance where the price can move to. So it would be $102.87. That would be right around here, like right around here, right at the support. So that's great. That makes it actually easier for the price to go to, because usually prices are incentivized to want to get to the support to see where they can move next to test it. So having that in mind, Baidu, because we're looking at Baidu. Baidu is a Chinese company. It's actually a powerful company. It's a search engine inside China. Baidu has liquid options, and looking at their option chain in February 16, you can see that the option that I decided to choose was 103 strike. So even though the calculator, which we got, was $102.87, I decided to get a strike a bit above it. But this isn't an issue, because as long as you have the average distance to be right around the strike price, then it's fine whether it's above it or below it, okay? Choosing the strike, it's going to cost $59. So we are going to choose 6 contracts with a strike of 103. It's a put option with this price. Once everything is good, you will click confirm and send. And what happened was, the next day, it went down, and actually went down to, I believe the price before was at 106.5. So it's now to 103. So it's basically a $3 decrease. And from this $3 decrease, the option now cost $132. That's great. We made a little bit more than 100%. And so our trade was successful. So that's how to trade options for beginners. In the next lessons, we'll talk about the intermediate level of trading options, which now I'll talk more profoundly of strategies, of methods of delta, vega, theta, mark, theta price, percentile IV, gamma, a lot of things. But right now, I don't want to overwhelm you with so much information. You got the most important parts about options, and make sure to research this quite a bit. But until then, I'll see you guys in the next lesson. All right. Take care. Bye-bye.